If you've been watching silver prices today and thinking, this is just volatility, this is just how markets work, I want you to pause for a second. Because if you're looking at this like a normal price move, you're already looking in the wrong direction. Here's the uncomfortable truth most people don't want to hear. Real market signals don't show up where you're being told to look. If you want to understand what's actually happening, stop staring at price charts. Stop refreshing your portfolio. Stop listening to commentators explaining today's move after it already happened. Instead, start paying attention to who controls the rules, not who wins the trade. What you're watching right now isn't just about silver going up or down. It's not about fear, greed, or profit-taking. And it's definitely not about a clean, efficient market-finding balance. What happened today reveals something deeper about how modern financial markets really function, and why moments like this tend to confuse retail investors while quietly benefiting institutions. Most people will walk away from today thinking, I guess I was wrong. A smaller group will sense something feels off, but won't know how to explain it. And a very small group will recognize this moment for what it is, a stress signal inside a system that doesn't behave the way we're told it does. If you want to understand that system, not emotionally, not conspiratorially, but structurally, keep watching. The reason most people misunderstand moments like this is simple. They're trained to think in prices, not structures. Mainstream financial media treats markets like weather reports. Prices go up. There must be sunshine. Prices go down. There must be a storm. So when silver drops suddenly, the explanations are always shallow and familiar. Profit-taking, overbought conditions, technical resistance, investors reassessing risk. None of those explanations are wrong. They're just incomplete. They assume the market itself is the primary force. They assume price moves are organic. They assume rules are neutral and fixed, but modern markets don't work that way. Most price action today doesn't come from millions of independent decisions colliding naturally. It comes from systems, exchanges, clearinghouses, margin rules, settlement mechanics, liquidity constraints. Those systems sit above buyers and sellers, and when pressure builds inside them, the response isn't gradual, it's mechanical. Here's the key reframe. Markets don't always express value. Sometimes they express stress. When volatility spikes suddenly, when moves feel violent and out of proportion, that's often not emotion. It's structure adjusting under load. Think of it like a bridge, not a wave. You don't study the water when a bridge cracks. You study the design limits. Most investors are watching silver and asking, why did price fall? That's the wrong question. The better question is, what constraint was hit? What rule changed the behavior of participants instantly? What part of the system needed relief? Once you start asking those questions, today's move stops looking random and starts looking revealing. And that's where the real analysis begins. Let's walk through the mechanics of the silver market, without emotion or speculation. It starts with COMEX futures and the concept of margin. In early January, margin requirements were raised sharply. This meant anyone holding positions needed to post additional cash immediately, regardless of their long-term outlook. When margin rises under these conditions, the effect is mechanical. Some meet the requirements, others reduce positions, and some are forced to liquidate. This creates a feedback loop. Falling prices trigger more margin pressure, leading to more liquidation. This dynamic plays out rapidly in the paper market. Meanwhile, physical silver markets move differently. Premiums are sticky, and inventory availability matters more than the screen price on a minute-by-minute basis. COMEX registered silver, metal available for immediate delivery, has trended lower for years, reflecting tighter supply relative to high paper volume. This isn't a conspiracy. It's a leveraged market reacting to a rule change. That is the factual backdrop of the current system. Now that we have the facts on the table, the important question isn't what happened. It's why systems tend to react this way under pressure. This doesn't require assuming bad actors or secret coordination. In complex financial systems, incentives alone are often enough. One possible explanation is structural risk management. When prices rise rapidly in a leveraged market, risk doesn't just increase for traders, it increases for the exchange itself. Clearinghouses exist to ensure trades settle even if participants fail. That means they are highly sensitive to volatility, concentration, and cascading defaults. From that perspective, raising margin requirements can be interpreted as a defensive move. It forces leverage out of the system. It reduces exposure. It shifts risk back onto participants. However, defensive actions are not neutral in their effects. A margin increase doesn't affect all players equally. Participants with deep liquidity can absorb it. Participants relying on leverage cannot. This suggests that structural adjustments tend to favor capital-rich institutions over smaller or more leveraged participants, regardless of intent. Another layer involves positioning. Public data from Commitment of Traders reports has historically shown that commercial participants, often banks and industrial hedgers, tend to hold large short positions during extended price rallies. Meanwhile, speculative participants accumulate long exposure. In that context, any action that forces deleveraging disproportionately impacts speculative longs while relieving pressure on shorts. That doesn't prove manipulation, but it does indicate asymmetry. There's also the distinction between paper and physical exposure. Futures markets are efficient at discovering prices for financial contracts. They are less effective at reflecting short-term physical scarcity. When physical supply tightens, the signal often appears first in premiums, lease rates, or delivery demand, not immediately in futures prices. This may help explain why futures prices can fall sharply while physical markets remain firm. Another possible interpretation is credibility preservation. Price discovery systems rely on confidence. If delivery risk increases or if leverage expands faster than deliverable supply, the system itself becomes fragile. Interventions that appear disruptive in the short term may be viewed internally as stabilizing in the long term. But stability for the system does not necessarily align with outcomes for individual participants. What emerges from this is not a villain narrative, but a structural one. Rules respond to stress. Stress exposes leverage. Leverage magnifies moves. Magnified moves reshape participation. In other words, markets don't just reflect value, they enforce constraints. And once you see that, the question shifts from, was this fair, to, what does this tell us about where the system is tightest? Because that's usually where the next pressure shows up. When you step back from the price chart and look at this through a systems lens, the implications extend far beyond silver. Events like this ripple outward because silver doesn't exist in isolation. It sits at the intersection of finance, industry, and geopolitics. From a market perspective, repeated episodes of sharp, rule-driven volatility tend to change behavior. Participants learn. Leverage becomes less attractive. Long-term capital begins to avoid instruments where rule changes can override thesis. Over time, this can reduce liquidity in paper markets while increasing activity in alternative channels. That matters because futures markets are designed to concentrate price discovery. When confidence in that process erodes, price signals fragment. For banks and large institutions, this environment reinforces a familiar pattern. Risk is actively managed, but only up to the point where it remains systemic. When pressure builds, mechanisms exist to offload or redistribute that risk, often in ways that are invisible to the public but very real in their effects. Currencies also come into play. Silver, like gold, functions as a monetary metal even if it's not officially treated as one. When confidence in financial plumbing weakens, clearing, settlement, collateral, hard assets tend to attract attention not because of speculation, but because of optionality. They don't require counterparty trust. At the government level, metals like silver increasingly intersect with industrial policy. Silver is critical for solar infrastructure, electronics, medical equipment, and defense applications. Tight supply or unstable pricing complicates planning and raises strategic concerns, especially in a world already facing supply chain fragility. On a global scale, this contributes to a broader trend, fragmentation. Instead of one unified market price accepted everywhere, regions begin prioritizing access and security. Premiums diverge, stockpiles matter more, trade policies become more assertive. What looks like a price event becomes a signal about trust. Trust in settlement, trust in liquidity, trust in institutions managing the rules. None of this implies imminent collapse. Systems can function under strain for a long time, but it does suggest a shift in posture, away from efficiency at all costs and toward control, redundancy, and resilience. And when systems move in that direction, the costs are rarely evenly distributed, which is why the next step isn't asking what this means for markets in the abstract. It's asking what it means for people living inside them. So what does all of this actually mean for someone living a normal life in the United States? Because if this stays abstract, people tune out. The first place it shows up is savings. Most Americans don't hold large trading accounts. They hold cash, retirement accounts, maybe a brokerage account, and a mortgage. When financial systems rely more on leverage and less on stability, volatility doesn't stay on Wall Street. It leaks into everything connected to it. Sudden market moves change risk models. Risk models affect lending. Lending affects interest rates, credit access, and refinancing. That's not theory. That's how the plumbing works. Next is cost of living, especially energy and technology. Silver is embedded in solar panels, electronics, medical devices, and industrial manufacturing. When supply chains tighten or pricing becomes unstable, companies don't absorb that cost forever. It shows up slowly, then all at once, in higher prices, fewer options, or delayed availability. You don't see it on a ticker. You feel it when repairs cost more, when upgrades get postponed, when temporary shortages become normal. Then there's jobs and income stability. Periods of financial stress often don't cause immediate layoffs. They cause hiring freezes, canceled expansion plans, and tighter budgets. That creates a quieter kind of pressure. People feel stuck. Raises slow down. Mobility decreases. Families notice it before economists do. And finally, there's long-term planning. Most people are trying to do reasonable things, save a little, reduce debt, plan for kids, plan for retirement. Those plans assume the system behaves predictably. When systems show signs of strain, not collapse, but stress, the real risk isn't panic, it's complacency. Assuming yesterday's rules will still apply tomorrow. This doesn't mean everything is broken, it means the environment is changing. And in changing environments, resilience matters more than optimization. Understanding that difference between growth-focused thinking and resilience-focused thinking is what separates people who feel constantly blindsided from those who adapt calmly. Which brings us to the framework behind this analysis. This is where I want to give you something you can reuse. Not an opinion, not a prediction, but a way of thinking. I call it the structural lens. Most people analyze markets from the outside in. They start with price. Then they look for explanations. The structural lens flips that order. Instead of asking, why did price move? You ask 4 questions, in this order. First, what system is involved? Is this a futures market, a credit market, a physical supply chain, or a regulatory framework? Different systems break in different ways. Second, where is leverage concentrated? Leverage is never evenly distributed. It always pools. Wherever leverage pools, fragility follows. Third, what rules can change suddenly? Margins, collateral requirements, settlement terms, export controls. When rules are adjustable, outcomes are conditional. Fourth, who can absorb pressure and who can't? This is the most important question. Systems don't remove risk, they move it. Usually toward the least flexible participants. When you apply this lens, markets stop feeling chaotic. Sharp moves stop looking mysterious, volatility stops feeling personal, and narratives stop controlling your emotions. You're no longer reacting to headlines, you're observing constraints. This framework isn't about predicting exact prices. It's about identifying stress points, places where the system is tight, fragile, or asymmetric. Once you see those stress points, you don't need to panic. You also don't need to chase. You wait. You observe. You position your life, not just your portfolio, around resilience instead of precision. That's the difference between being informed and being anchored. And it's how you stay calm while everyone else argues about charts. This is where theory turns into something practical, not in the sense of trades or predictions, but in how you navigate uncertainty. First, separate exposure from belief. You can believe a system is under stress without overexposing yourself to it. That means avoiding situations where a single rule change, margin call, or policy shift can force a decision you didn't want to make. Optionality matters. Second, pay attention to instruments, not just assets. Two people can be right about the same underlying reality and have very different outcomes depending on how they're exposed. Leverage, counterparty risk, and settlement terms matter as much as the thesis itself. Ask yourself, if conditions change suddenly, do I still control my decision? Third, watch signals, not noise. Prices move fast, structures move slowly. Inventory trends, policy changes, credit conditions, and supply chain behavior tell you more about long-term pressure than intraday volatility ever will. Fourth, build resilience before optimization. Most financial stress doesn't punish people for being wrong. It punishes them for being fragile. That can mean too much debt, too little liquidity, or too much dependence on a single income stream. Resilience looks boring until it isn't. Fifth, zoom out regularly. If you only look at daily moves, everything feels urgent. When you step back and view systems over months or years, urgency turns into clarity. You start seeing cycles instead of crises. Finally, keep learning, but selectively. Not all information is equal. Look for sources that explain mechanics, incentives, and constraints rather than personalities and predictions. The goal isn't to be early or loud, it's to be steady. Which brings us to the last part. Not a call to action, not a warning, just a shift in awareness. If you take one thing away from this, let it be this. Markets aren't just places where prices move, they're systems that enforce limits. When those limits are tested, the signals don't always show up as clean explanations or tidy narratives. They show up as sudden moves, rule changes, and outcomes that feel unfair if you're only watching the surface. That doesn't mean the system is about to fail. It means it's revealing how it really works. Once you understand that, your relationship with uncertainty changes. You stop reacting to every move. You stop needing constant confirmation. You stop feeling like every headline demands a decision. Instead, you start asking better questions. Where is the pressure building? Who has flexibility and who doesn't? Which risks are visible and which are quietly being transferred? This kind of awareness doesn't make you richer overnight, but it does make you harder to shake. And in a world where systems are under more strain, not less, that may be one of the most valuable advantages you can have. Stay observant, stay grounded, and don't confuse noise for truth.